All right, guys. So welcome to another mastermind call. Today's going to be Tuesday, May 26th, 2026, guys. We're literally about to end the day. So if you're in the US, happy Memorial Day or post Memorial Day. I'm sure you are rested, you weren't drinking too much, and you're ready to get back into it. All right. So for today's training, what I want to cover is deal structure. So this is going to be deal structure for your team. And it's going to be deal structure if you decide to do referrals. So before that, what I want to do, pull up the comments and see where everyone is watching this from. So I have Clarence, Mr. Davis in Arkansas, Steve, what's going on, brother? Brent Espinoza in San Diego, California, so Southern California, Arkansas, I love Arkansas. And then we have Ohio here also. So pretty cool just to see who's watching live, because I see the analytics and I'd say the majority, like 80% of the people are usually watching a replay every single week. So this is pretty cool, right? So I'm going to cover a few things. Now, first things first, let me pull this up. Then give me one second. I'm going to pull up a new tool. I mentioned this last week, I think on Thursday, but I want to get you guys the link to this and then a few other things. I'm rolling out a few things for you so you can access it online, which we basically remove the password to make it much easier for you guys. But it'll be live. Okay, cool. So let me do a screen share if I can find my screen. Give me one second. And we'll get you guys this link after 2. Okay. So where is my screen? Share screen window. We have it right here. Make sure. Awesome. So we got this right over here. So essentially, this is to help you out as you're pricing accounts. And this is also going to help you with this training right now. And the reason why is because as you start bringing in referral partners, which are obviously a great benefit to yourself, or just have people that maybe they send you one person, you say, how can I compensate them? You can use this to help you out also. Okay. So you'll have access to this. It'll be on the internet, be bookmarked. We'll have a whole list for you guys to bookmark. So you can just go through all your different tools, but essentially it's going to be estimating the residuals, right? So let's just say an account doing $50,000 a month, for example, and we'll say it's like 12 out of 100 people use crypto payment at that business. So we have our base fee, which is 2% right here. And then once we have that 2%, let's do this. See if this goes a little bigger. One second. There we go. Yeah. So once we have the 2% there, you price it above it. So 2.25, 2.75, etc. Okay. So now that we have done this much bigger, here we go. This is beautiful. So now that we've done it much bigger, you're going to start seeing the profit roughly, okay? Because you might have a peptides account price much higher, especially since they can't get credit card processing, maybe a strip club or a casino, etc., where, all of a sudden you realize DoorDash, Uber Eats, they charge you roughly about 12 to 15%, and people don't even think twice about it. So you start realizing, oh, it's maybe a limiting belief to charge. Now, let's just say we have an account doing 6%, okay? One of these other accounts. Then the question is, well, did you add in the credit card side also? So if we've added in the credit card side, well, then there's some other variables, but I'm going to do that in a second, just for the sake of simplicity, because these are basically stages, okay? So do this. We do the equipment cost. So let's just say, for example, $250. Okay, just for even numbers. Then we break it down. We go into your commissions. We go into monthly. This is the profit. So it's above it because remember, 2% fixed fee. If you do 4%, 6%, whatever, you break that in and you go into numbers here. So we have this, and these are projections, obviously, annually, how much it would be, break even for the actual device specifically. Obviously, it could be delay for the first transaction, but you get the idea of what is being said here, okay? And of course, there's no guarantee because we don't know what's going to happen with that account, but this is for you to plan as you start building and scaling, okay? So next, the follow-up question is, well, what if I do credit cards? So as we add in credit cards, obviously there's some variables there too, but you'll start seeing accounts that sign up for both. We're going to choose what? Are we charging it to the merchant or are we doing cash discount? What are we doing? Okay. So in this case, we're going to be charging it to the customer. We're going to choose the rate. So you have some example rates here. And the whole idea is that it's not going to be in like the 0.1% range, because usually it's even numbers like this is what we stick to, but you get an idea. So for example, let's just say you choose 3% charged, or we'll say 4% charged to the actual customer. So it kind of gives you an idea of roughly, depending on the type of account, what would it be? And the reason why I put it here too is that ultimately there's underwriting. So it's kind of like getting a mortgage, where I might say to you, hey, yeah, your interest rate's going to be 2%. Okay, if this was like 2020, 2%. And then they start pulling up some of the covers and they're like, whoa, okay, actually it's going to be 2.7 because of X, Y, and Z. So you get an idea of, obviously it depends, but we're going to do the equipment cost. We have the actual processing amount, and then it goes off of the percentage. So if we say, let's just say 10% do the on the crypto side, then the other 90% obviously be, and this is assuming no other growth, no other customers whatsoever, just what the data we have. Then you're going to break down what it looks like for you. So we start looking at the equipment cost. It might be, let's just say 500. So we have the residuals popped up over here. You have numbers, you see break even, and it tells you here also. And let's just say they have a POS, like a point of sale system. You decide, hey, I'm going to completely replace them. So that device, let's just say 1500. Then it breaks down that you'd break even on that account for the device roughly in about like 2 months. Okay. So again, this is to help you price different accounts. We'll send you the link to access this in your guys' channels. And it's going to be really, really, really simple for you. Okay. So with that being said, and if you do want access to this, can you comment residual below if you do want access, so we don't bombard your chats, and then we'll send you access as a priority, and then we'll roll it out to everybody else after. Okay. So now what I want to cover is going to be referrals and deal structure. Okay. So this is actually a pretty cool subject. And the reason why is because ultimately I've gotten this question a few times. Actually, I was talking to somebody earlier this week, and they were breaking down, hey, I might have like 20 or 30 people under me. I'm going to have like this referral arrangement, etc., which is pretty cool. We encourage that. Ultimately, we do business with you as the client, so you get the benefits. Obviously, you can always just do credit cards or trade the crypto elsewhere, but you start realizing, oh, all these other things are the reason why I'm going to be successful at this and these structures. So now, when it comes down to team and referral structure, well, ultimately, the reason I bring this up is a question that I've got is like, hey, get them. I've decided I'm going to have 2 people start to find locations for me. Okay. Now, how the heck do I pay them? Which is a normal question, which is okay, right? So as we start talking about this, let me see if I can make this bigger. Basically, the way you want to think about it is like this, okay? So let me make sure you guys can see my screen. Let me do this. And then I'm going to zoom in right here. Oh, I see. Give me 1 second. Boom. There we go. So, beautiful things. There's basically one of 3 ways you're going to structure this, okay? Option number 1 is you do it. And what's that mean? It's what you're doing already. You run ads, marketing, etc., and you start looking at these locations, okay? That's like the basic model. It works. You could ignore all this and still be 100% successful. That's how I've always been. And then I saw the benefit of building teams. Building teams make a difference. So that's option number 1. Option number 2 is you hire to do it. What's that mean? You actually hire employees, team members to actually function on behalf of you to expand faster. Okay. That's a more common one. And then the other one is you bring someone to do it. All right. So what's that mean? Well, you're not directly hiring them. There's some type of arrangement where they're going to profit with your structure, meaning that it's like, hey, it's in your best interest to actually send this to me because I'm going to pay you, fixed fee, percentage, whatever. Okay. So the question is, and I always say why, is like, what's the importance of this? So number 1 is if you have the wrong structure, that equals to dead partnerships. If you have the wrong structure, dead partnerships, because what ends up happening, and this is common, unfortunately, is that initially people are loyal to you. Okay. And if you've been in any type of other business, you know what I'm talking about. I know some of you guys have like small businesses and you start realizing like, man, that customer I thought was going to give me like a 5-star Yelp. And then all of a sudden they freaking disappeared and I see them with some other logo on their bumper sticker, right? It happens. So we want to make sure we incentivize to keep them also because you want them to continually provide you. And then the other thing is going to be if it's the right structure, that equals 100% upside for you. So all of us obviously want this because let's be realistic. If you can multiply your efforts by having other people involved in it, it's a no-brainer. Okay. So the next thing we always try to basically think about, this is the lens we think through, is what I like to call the operator's problem, right? Because you are a business operator. And what's this actually mean? So essentially, number one, you cannot be everywhere. You have to just recognize that. Okay. You're the jack of all trades in your business in the beginning, but you just can't be everywhere. And since you start to realize that as you sign up your first, second, third, fourth, fifth account, you immediately start thinking, okay, how can I get this done faster? And this is the reason why we bring this up, right? And then ultimately what ends up happening is this: the deal structure will turn your network into a sales force. So what's that mean? Well, you obviously know other people. You have friends, family, business owners, bankers, etc. Like as much as your network is saying, like your network equals your net worth. Well, this is what we're referring to. Well, hey, you should be able to take advantage of this. And this is why we always bring this up. Okay. So what we're going to cover is a few different things. First things first is, different types of contractor subject or structures, like how we actually do it. And then obviously like how we incentivize those deals. And then from there, if you're going to use a hybrid or structure, we'll go over that too. Okay. So ultimately the next thing is going to be hiring structure, right? So when I say hiring structure, there's essentially 3 different ways. My spelling is not the best right now. So number 1 is going to be 1099. One is going to be an actual W-2 or directly employed. And then the third one is going to be like a hybrid structure. Okay. So the 1099, obviously this is USA based, but it's the same thing in Canada or North America. And there's usually some type of variation in different countries. I know in certain countries there is like an employee that works full time and there's people that do contract type work, but there's things that delineate the difference between all of them. Okay. So with that being said, what we typically recommend is going to be starting with a 1099. And just to be clear, what this means is it's a contractor, right? It's 1099 of the actual code, the IRS tax code. So what's that mean? Ultimately, they have no benefits. They have no payroll taxes because this becomes a pain for you too. No employment liability. This is small things you don't think about, but it becomes big. And then you keep everything. So ultimately, think about this. When you start working with somebody, I like to treat it as if I am looking to get married. So if somebody is going to get married, it's probably not going to be on the first date. So the structure I like to have is usually having an actual 1099 contractor. And then we say, awesome, if this is what we want to move on to in the future, like we want to stay long-term or we figure out if this works out, now let's move into an employment relationship or some type of hybrid. But either way, there's an upside for them to stay with you. So it's the same thing with hiring people to actually start finding locations for you or actually work directly for you to solicit these deals, because ultimately you want to make sure you have the maximum upside and least amount of risk in the beginning. And then as you gain more trust, again, the second date, the third date, then all of a sudden you say, okay, cool. I like the way things are going. Let's talk about long-term relationships with this. Okay. So with that being said, knowing that, there's a few things we want to consider, right? So on one side, you might say, hey, that's not fair for the actual contractor, but it's actually not true, because for the contractor, there's a better tax relationship also, because they can claim whatever they want. They can do it as a small business, and all of a sudden they get the same benefits. They're just not going to have with 401ks and like some of these other like benefits. Okay. So knowing that, there's a few things we want to consider. Okay. So The first thing is going to be this, right? Pull this up. Considerations is, and this is also like the benefit to you, is that they pay their own taxes and there's no benefits. Okay. And there's other thing, there's technically IRS misclassification risk. And I say that because depending on how you structure this, it's rare this is going to happen, but ultimately, if you make it into 100% employment relationship where you say, hey, at this time you start, this time you end, you have to be in the office and this and that and this, well, then it doesn't pass the basic, I'm going to call it the crap test. Okay. You're going to excuse my French. So it's not going to pass the basic crap test. So in the, in the rule books, especially the IRS, there's all these different tests. Okay. And luckily, like even law enforcement, so I get this, right? There's like Graham v. Connor and all these different things when you're doing things. Well, there's different rules. So you might have a test to say, hey, is the vehicle actually used for your business? So they'll say, well, what's the percentage of time you actually drive the car? What's the percentage of this? What's the percentage of this? Or for me, I like to save as much money, and I'll say, hey, my haircuts, they're for the business, right? And obviously I don't have the same haircuts, but ultimately it comes down to this, like, well, what a part of your business aspect requires the haircut? How much of your haircut benefit is going to what? Personal life. Well, are you Kim or Kanye West, or are you just some random guy vlogging on YouTube with 2 subscribers? Like, all these factors are considered, because if I'm an internet personality and I have, Mr. Beast, and I say, hey, we're actually doing St. Baldrick's, like the Cancer Foundation, and we're going to shave our hair. We're going to do this, that haircut all of a sudden is like, well, yeah, this makes sense. So the one thing with having contractors is, depending on their skill level and who you're hiring, sometimes this is a concern for them, where they say, well, I don't know how to pay my taxes, or I want benefits or things like that. They want that job security, but they don't realize the benefit to that. And then the other thing is, if you become a little too strict on what needs to happen, then all of a sudden it's like, well, wait a second. Is that a roofer? Like, is he coming to do your roof, or is he your full-time maintenance person? And you start seeing how that's very obvious. Are they doing a one-time thing that's just continually happening? Like, hey, every week you're going to fix my roof? Or are you saying, you will check for my roof? You're going to show up at 8 a.m. You're going to do this. You're going to do that. You're going to do this. Again, it's very rare, but you have to understand that you're not skirting the law. You're just using this to their advantage, where they save as much money as possible too. Okay. So with that being said, a few different things, right? Ultimately, we talk about the misclassification risk. And I want to knock this out first, because I hate talking about like the freaking federal government and money to pay them and all that. I think it's absolutely terrible. Sorry, guys. I was in the Marines, I was in law enforcement. I think it's freaking ridiculous that you're going to pay 30%, which is nonsense. But hey, what can I say, right? So with that being said, there's the different things like the IRS actually looks for, right? And I'm going to cover this because it's a big enough deal when you're new to business. Once you've done this a few times, it's just obvious, because it's a variation. And it's kind of like, Spanish, for example, and then you want to learn business Spanish, and then you want to learn, technical Spanish, like scientific Spanish. There's different words. Well, as long as you have the foundation, you're good. Now, if it's your first time and you're trying to do a press conference, you're about to be in for a rude awakening with the interpreters. So there's a few different things. There is behavioral control. And again, this is not legal advice, guys. Seek a qualified tax professional or an attorney for this. Behavioral control, and then there is going to be financial control, and then there's going to be, I'm typing, but there's going to be the relationship type. Okay, so let me put this down here. Now, we're going to make this very, very simple for you, right? So these are the things we essentially just want to avoid, all right? These are red flags, and this kind of passes everything. First thing is a set schedule. If you remember anything, from this, let's just avoid the set schedule. Okay. So what I mean by that is, you say, hey, you have these days off per week. You are working from these hours. You have to check in here. You have to be at this place, etc. Okay. So that's the number one thing. If you do that, and to be clear, it's not, well, hey, this guy is finding locations for me, so he has to be available during business hours. Well, yeah, that's clear. Obviously, you can't be obviously saying, hey, you're going to start and work from 12 a.m. to 4 a.m. and you're going to go in person and find locations. Like, that doesn't make any sense, right? So there's obvious factors regarding, like, hey, to do this contract, You can't do construction before 6 p.m. So you need to come after 6. That's different. But if you're saying, hey, basically, if you're signing up to work for Walmart and they give you this entire employee handbook and these are your rules, now you start running into a red flag. Okay. And then if you provide the tools, okay. So again, I'm saying red flags. Okay. This is what I'm saying is red flags. So if you're providing the tools, like you're saying, here's your computer to use, here's your lead finder, here's your phone, here's all these different things, you start running into like, well, wait a second, like, are they forced to use that? And you start asking questions. Okay. And then ultimately it's your expenses also. So if you can get them to use a lot of their own equipment, technology, even if it may be a little subpar, why not do that too? And then if you give specific instructions, so you're saying, hey, you will do it this way. Here's 66 pages. Now there's a difference. There's a scope of work, SOW. And if you're in any type of service-based business, you understand that. And then there is like, hey, these are the ways we do it specifically this way. You'll be here, etc. And you start realizing what I'm saying is if you become extremely specific on how they have to operate, when they have to operate, and there's exclusivity, now you have a problem. So you're saying you will not do anything for anybody else. There's a difference between a non-compete, meaning that, hey, you're providing me services, you're provided with, I'm providing you with like special information for my software business. You can't leave and just go to a competitor. That's different. But if you're saying, no, you will never code for anybody else, you're not going to find any locations, etc., we start running into issues. Okay. So enough about the negatives. I hate covering negatives, but it's just so you understand that if you're going to get somebody with the contractor role and you want to take advantage of this special, relationship, let's actually make it compliant. Okay. So what's that usually look like? You typically want to measure their results, and then you want to define what the outcome is, not the exact process. So for example, whenever I have contractors, I say, hey, ultimately here's what tools we use, like here's software, etc. And I'm looking for X, Y, and Z to occur. Okay. So it's the same thing when you're hiring somebody to do this for you, saying, hey, I'm looking for a location to be signed up and up and running. Now, do you have to log into Google Sheets every single day? No, but this is where we record our deals. Here's where we record the people you talk to. Here's how you provide the information I need. And now it's up to you to be creative to make that happen. So that's usually what it looks like pretty good. Okay. And then the other option we have is going to be W-2 employees, right? So these are going to be realistically, and I want to highlight this, is when you scale, okay? Do not start with W-2 employees. You're going to be in for a rude awakening, okay? Especially if you have no cash flow coming into your business. We don't want to do this. There's just too many negatives, okay? So typically we want to do this when, number one, when we're profitable. And this could be, obviously, you define your success. You might say, once I make my first dollar, I'm hiring my employee. Probably not, but as you start getting more accounts. And then from there, when you actually need a full-time position, okay? This is not going to be necessary in the beginning. So what we want to do is typically convert the 1099 to W-2. And this is to incentivize them to stay. All right. And you might start adding benefits. You might start adding different things, but this is the structure we typically want to follow. Okay. Now, with that being said, there's a few different pros. All right. So the pros is going to be you have more control of what needs to actually happen. You're usually going to have some type of loyalty because there's benefits involved, and there's going to be more stability because you're not saying, hey, I need a contractor for 2 days out of the week. Monday through Friday or Monday through Saturday, it works. Okay. And then typically you're going to have day-to-day, so management abilities. So now you kind of understand like the benefits of like you have consistency. Okay. So with that being said, here's some of the cons we run into. And this is really why we say don't want to sign people up initially for this, is it's going to be more expensive because you have fixed expenses happening in. It will end up being 25% or more in overhead for your company because you have different benefits depending on the state they're in. There might be some mandatory minimums, FMLA, somebody gets pregnant and they have problems, like things like that. It's going to be a little more inflexible because, again, they're employed, right? And then from there, you are legally liable for what actually happens. So for example, they go to a merchant, they lie to them, and then all of a sudden it's like, well, hey, your employee said that to me. So now there's a different thing. Or your employee pushed over my rack as they were trying to set up the device. Is that likely? No. But these are things you need to consider for your business. And this is if you have 100 employees or even just one, it doesn't matter. It's the same. So what I like to stick to is going to be the hybrid model. Okay. And this is going to be depending, obviously, like this is after you've signed up a few accounts on your own. But essentially, what we're going to do is this. We're going to have some type of 1099 commission. Okay. We're going to go over that in a second. We're going to have a small retainer just to cover, you call it a base if you want to also. And then what we want to do is only provide this for proven performance. Okay. So I say this because ultimately think about it like this. You are incentivizing talent to stay with you. Okay. This isn't a charity case. This is business. This is cutthroat. Forget anybody's emotions. Okay. I want to be absolutely clear. It doesn't matter what somebody feels. I don't care. This is ones and zeros. So understanding this, you want to have good talent. So there needs to be some type of model like this. Okay. Because let's just be realistic. There are millions of people out there. And especially if you're doing this remote where they're calling for you, etc., you start realizing like, no, that's not okay. Like I need to hold my standards. So you need to do this with your team members, especially if they're going in person. And the reason why is because if you don't focus on proven performance, you're gonna have problems. You have somebody representing your company. So whatever they say is a representation of you. It's kind of like when kids mouth off at school and the teacher's like, oh, where'd you learn that from? They're a representation of your name, your brand, and your brand getting better results in more people wanting to work with you. Your brand getting tarnished, well, now you have really big problems, okay? So we want to save this for proven performers. So essentially what we want to do typically, and I'm going to break down like when we use this. Let's go here. So typically when we go from 1099, which is just a fixed rate that we pay them, like per deal, to hybrid where we start incentivizing, usually they're closing multiple deals for you, or they're closing bigger deals, and you define what bigger is. Okay. So obviously there's clarity in everything. So you decide for your business what makes sense. They're obviously proven performers. So usually this happens, less management needed. They are helping you grow autonomously. Okay, this is big. And the reason why is because you don't want to babysit people. Okay, there's a saying I keep saying like janitors. Not janitors aren't a problem, but ultimately you don't want to have to constantly send a message back and forth like, dude, figure it out. So you want to incentivize like the right behavior, like the right type of person. They have to be a culture fit. Okay, and then from there you want to incentivize them to stay. Ultimately, that's it. Because I'll be frank, the likelihood of them finding another position like you're going to offer is extremely low. Okay. It's a very lopsided relationship, but you do want to incentivize the person to stay because, you know, all you have to do is go to Fiverr or Upwork. These are two different websites, and you're going to see there's a plethora of talent. Or if you go to any Facebook group with like 30,000 members or more, there's all these different job boards for different positions. You're going to see that as a lot, but I don't like to sift through the mud all the time. So if you have somebody and it's like, hey, maybe they're not the best, but they're doing pretty well, you don't really need to talk to them. Like they know how you operate. They know what you like. If you have somebody doing 60% of what you'd like, I find that better than trying to find that 90%. Because ultimately, let's just be realistic. The time involved means less time working on deals too. Okay. So that's typically when we want to do. So an example, just to be clear, because I know this is gonna be the next question, is it might be something along the lines of like, hey, $1,000, monthly retainer plus $200 a deal. Okay. And you're probably thinking like, holy crap, it's a lot. Well, we define what this means to us. So you might say, hey, it's gonna be $200 for every deal that involves credit cards and crypto. Cool. So now they have 5 deals for you. We use our calculator and you realize, oh, I see how I can make this actually work for myself, right? This is why they all go hand in hand. I gave you guys this link also. So you might do something like this. And so what this does is it creates stability and it creates an incentive. And if you bring those together, these are the two things you want to remember. So stability incentive, what's that mean? Well, at the end of the day, we are humans. We are irrational creatures and we need stability. And you might think, oh, I'm the special snowflake. I think that all the time of myself. I'm the special snowflake. And then reality hits me. So the stability sometimes is instability. And you guys probably know those people. They're like degenerates. And if you don't know anybody, it's probably you. I'm kidding. Or, you have an addictive personality. So you are consistent and being inconsistent. But either way, there needs to be some type of pattern. So one thing you learn in entrepreneurship is ultimately what drives results. And it's not money a lot of the times, because the money is a result of something. Like, it leads to something. The money pays for the 91 octane gas that pays for the Porsche to drive. The money pays for the daughter to go to the private school and learn 5 different languages. The money pays for the freaking gambling addiction. It doesn't matter, but you realize it's not the money. The money is the instrument. So when you realize this, you say, okay, for me to get good talent and for them to actually want to work with me, again, these are the employees, but it applies to everybody, because you're selling at all times. As much as you may not like sales, and I hate sales, I absolutely despise it, you are selling. So you have to understand that you have to sell this person on wanting to work with you long term. And if there is a relationship like this, it's kind of like, some of you guys are probably thinking about your dating relationship now, like, oh yeah, that makes sense. Well, when it sinks and that feeling, you're going to realize, oh, this is rocking. Because if you're paying somebody $200 a deal, they sign up, let's say 3 a week, that's $600 a week. That's times 4, that is $2,400 plus the 1,000. Now they're making $3,400 a month, which is about almost $40,000 a year on top of whatever they're doing. Or maybe they don't want to do anything else and they make an LLC and they do a lot of tax write-offs. They're making basically the equivalent of like $5,000 a month, which is like US salary. So think about that for a second. You may think like, oh, $200 a deal is not a lot, but it is. And you start realizing like, whoa, you can start attracting the right people. Now, if you start adding in incentives and you say, hey, we're going to do $200 per deal, but if we do 7 in a week, I'm going to bump it up to $300. So now they're like, wait a second, 7 times 300, that's $2,100, right? So all of a sudden you realize like, oh, that's a lot of money. Okay. Or you say something along the lines of, hey, if it's just a crypto only account, it's gonna be this much. But once they sign up and they're fully up and running, then it's this much, an extra $20. And we talked about this last week in the training, but it's going to be an extra $50. And then from there, it's going to be another $70 if they add in this, another $80 if they add in this. So once you start doing the mental gymnastics, you're like, whoa, for this one deal, I can make $500. Again, you're not just wildly throwing out numbers. You're saying, hey, I know that if they get me an account that pays me $100,000 a month, okay? Because you do a bonus for anything over 70,000 as a bonus, for example. You start running numbers and you're like, all right, and if they sign it up for the highest cash discount, I'm going to be making roughly total about this much. I'll make $1,600 a month. So I have no problem paying them $500 or $1,000 or whatever. So someone else might call you crazy, but you've already ran the numbers. You say, that's okay. I'm making $600 a month and I can break even on this device really quick. So this is the considerations we want to have. It seems like it's complicated, but it's not. You just run simple numbers. You run a simple comp structure. And we have examples with tables we can do too, but you start realizing how this makes a lot of sense for you. Okay. So with that being said, right, what do we want to do? So we want to focus on the actual deals, what it looks like, right? So I call this like a base structure without, and this is not the hybrid, right? Structure. And that's typically going to be, let's just say $200 a deal. Okay. And again, what's deal mean? So what that actually means, because you have to define this, okay? You have to define, we're going to say it's a signed up and processing. Okay. So what can we do? We can do a breakdown. We can say, whoops, this is an option, or you can say it's all or none, right? It's kind of like gambling. So you can say something along the lines of it's either all or none, or it's tiered. And this is usually to provide a little dopamine and incentive. Forgive my spelling. I'm usually much better, but I got to get a little more caffeine right now. So it's tiered. This is to provide that dopamine for them. So option number 1 is it's going to be all or none, meaning it's just $200 or not. So if they don't process whatever, but you can kill motivation with that. Or we do the tiered. So I like to stick to the tiered. And the reason why is because it's going to help. And it feels like a loss initially, but it's not such a big deal. So we define multiple points in the sign up. So we say the actual sign up, so like the application. Then we say documents, and then we say device installed, and then we say processing. first dollar. Okay. So these are 4 different parts. So we want to weigh them appropriately because obviously the application is going to be the hardest. So this is typically going to be about say like 30 to maybe even you can say 50% depending, but this is going to be the hardest. And then we have the documents is going to be closer to about like 25% because it requires some follow-up. And then this is big also. Okay. The device installed is usually just a result of this. So you may not want to incentivize it. So we can just split it up over that. We say, hey, okay, so it's going to be for the application is $100. And then when they get the documents, it's going to be another $50. And then process or dollar is 50. And this is just an example. But again, this is how you find out how you can start incentivizing them to work more and more and more and to actually grow with you. Okay. So we say, why $200? Well, it's low enough to scale and it's high enough to motivate them. And then ultimately you keep basically 90 something percent of the revenue because there's no residuals. So again, when we want to incentivize them, there's options, but the option is equal a percentage too. So you might just say, hey, I want long-term value. So I'm going to give you $100 when they sign up, but you also get 10% of the profit, 20% of the profit. Again, sometimes people don't see long-term big pictures, so they don't want that. They want money up front, which is totally fine. But these are just different options you can do. Okay. So with that being said, what can we do? Well, maybe we add in the cross-sell bonus. Again, these are different structures you can use. So you might say, hey, that's for the crypto side. But if they sign up for credit cards, it's another $100 bonus for credit cards. And it's another $100 max cash discount or dual pricing percentage. Because if they just sign them up for credit cards and they do a really low rate and you're only going to make 0.25% profit because they price it really low, now you have a problem, right? But if you say, hey, we started at the highest where we can lower more in the future, you know you're going to get a lump sum of your money up front. It's like mortgages. When you get a mortgage, you notice the first 7 years of payments, it like barely goes down. It's because they're paying all the interest up front. The bank knows that you are going to do what? You're more than likely not going to stay in the house past 7 years. So give me my money. I want my interest up front. So it's the same thing with this. You know that, hey, there's risk. 2 years down the road, they may leave you as an account. So let me profit as much as possible now. We can talk about lowering the rate later. So knowing that you want to incentivize your employee or your hybrid employee as to how to do this also. Okay. So with that being said, when it comes down to recurring revenue, there's a few different options we want to remember. Okay. Because this is in and of itself a whole nother subject. So recurring revenue for a team member. So we want to incentivize them to work with you longer. This is the main reason why. Or we want to incentivize quality. And this could be either a quality team member or signups. So how do we do that? We say, hey, this is not a short-term gig. I don't want you to be like a Fiverr or like a scab labor. I want you to work with me long-term. So it needs to be in your best interest to work long-term. So as long as you work with me, I will give you a piece of the percentage. Or as long as you work with me, I'll do X, Y, and Z. But basically, this provides an incentive. So we break down the actual math, right? So we say, hey, the economics or the math behind it, okay? So we say, hey, I have my profit, okay, equals $1,000 a month. We're just going to say that, okay? And again, it depends on the percentages and all that good stuff. So what we want to do, we have basically one of two options. We say we incentivize based on quantity of accounts, or we weigh the quality. And this is usually going to be revenue, so higher revenue amounts. And then we want to do elapsed time of employment, okay? So these are usually the 3 tiers we use. Quantity, we weigh the quality. So weigh the quality of the accounts, or we do the elapsed time that's going to be involved. Okay. So it's really simple. You say, hey, once you get to, we can, usually do something along the lines of this. And remember, we can use this in combination with the base, right? And then 5 to, or we'll do 10 plus, 20 plus. So we might say, hey, you know, first one, you keep 10%, right? Next, and then this could be the first. I'm going to make this really simple just to help out right now, because if you really get in the weeds like this, you can run into some issues. But we'll say something along the lines of this for the sake of simplicity. Okay, 5 to 9, 15%, 10 plus equals, you know, we'll say 20%. And then you want to usually have a big jump. So we go to 20 plus accounts, that equals about 35%. So you start realizing when off of this $1,000 a month, accordingly, it turns into 100 a month, 150 a month for each account, right? And then we go into, you know, $200 a month, 350 a month, etc. So it doesn't seem like a lot, right? Probably thinking like that's not that much money. But here's the lopsided relationship. You're taking a lot of the risk. That's why you keep the majority of the profit. Okay. But as they start adding in more, well, when they get 20 plus accounts for you, we want to incentivize them. But now we start talking about, well, for each month they were already getting, let's just say $200 per account. Okay. So if they're already making, let's just say they got you 10 accounts in a month, that's $2,000. Okay. So this is equals $2,000. And then at the, let's just say 20 plus account mark, that equals another $350 a month already built in. So you start realizing how they can really start compounding their income based on this. And that's why they want to stay with you, because you get pretty aggressive on what you're willing to offer. Okay. So the way you have to think about it is like this. Okay. There's factors for professionals. And what I mean by that is when we are hiring more people, well, there's different reasons why they want to stay with you. Okay. Remember I said it's not about the money? Well, ultimately it comes down to existing relationships. It's kind of like this. You might have that friend who has a bad relationship. You're like, dude, you need to break up with her or him, right? We're going to be gender neutral here. Well, ultimately, what do they not want to do? Oh, it's uncertainty. I don't want to leave. So typically they end up staying with what works. Now, trusted advisors. So, and mentorship. Advisors and mentorship. So what's that mean? Well, ultimately, think about it like this, okay? So if you're able to provide more to them, and what I mean by that is you're able to provide advice, you're able to provide different factors, et cetera, that works for them, they're actually gonna want to stay with you. You know why? It's because there's more to it than the money. And I've had this in the past. Like I've had some, you know, I've had some team members in the past over the last few years where it's like, hey, you know, out of curiosity, like you're really smart, like you're in finances and this and that. Like, what do you want to do? He's like, I just learned so much from you, get him. Like, what do you mean? He's like, well, this is like I had a team member that went to Wharton School of Business, which is, you know, like the Harvard of business. And he's a young guy, super sharp. And like, why do you want to stay here? Like, you know, let's just be frank. Like, there's a lot of opportunities. Like, you know, I just learned so much. I'm learning more here than I learned in business school. So what do you mean? It's like, well, just the way you think, the way you're analyzing these situations, et cetera. You know, I may not make as much as I can right now, but I definitely am making more long term because I'm in the season of learning, not earning. So again, if you become that trusted advisor, or you can provide some type of advice, and don't think of yourself so small. You know things that you don't realize you know. These are all different quirks, different things you became efficient with. So they want to learn those things and they stay with you. Okay. And then when it comes down to there, it comes like this. They're incentivized. So this is going to be usually financially. And then they're recognized. This is big. And I fall for this all the time. Sometimes you just got to recognize work. And that's all people need. I'm telling you, when I was a police sergeant, and you know, we'd have the craziest scenes. It'd be like shootings and like this happening and that happening, like chaotic event. I'm like, all right, let's rock. And you'd have a random person come up to you, like, oh, here we go. And they'd say, hey, I just want to let you know, like, I really appreciate you. Like, what do you mean? It's like I live up the street and you know, I feel safe with my kids because you're here. You're like, damn. And that's it. It's not the news being there, CNN and all this. It's just some random person saying, awesome. So it's the same thing with team members also. Okay. So with that being said, when we're doing this, this is typically what I like to stick to for account structure, like paying them. Okay. Now, when it comes down to it, let's start talking about affiliate partners, right? This is really similar. So that's why I wanted to cover that first, because of deal structure and everything. But ultimately, when we're talking about affiliate partners, there's usually a few different options. So there's usually marketers. From there, let me just pop this bad boy down here. So we usually have marketers, maybe like content creators. There's going to be, affiliated fields. So proximity. And what's this one? This is going to be the more common one because you're not going to go after influencers. These are typically going to be like bankers. These are going to be accountants, tax strategists, and there's going to be different group affiliations, right? So like Chamber of Commerce, race and biz. So this is usually like, hey, Black business owners or Asians in finance or things like that. Like these are different groups that are usually race affiliated. That's usually what it is, but you get the idea. So this is what they typically are. So that's why this is a little different. They're not working for you, but there's more of a relationship involved. Okay. So this is relationship versus employment. This is a big difference. Okay. This is also, to be frank, is where respect comes in because ultimately they don't need to. So we are usually taking advantage is this. Number one, distribution. They usually have some type of distribution superior to yours, and we want to take advantage. Okay. And then from there, they're usually motivated either currency or social currency. We talked about this last week, but basically there's a financial incentive or there's a long-term financial incentive where it's like, hey, you can refer me here, or, you know, I'm a realtor. I refer you different mortgage clients. And when you have a mortgage client that gets pre-qualified and they don't have a realtor, they refer it back to me. Okay. So this is the social currency plus currency combined. Okay. So when we typically do this, when we talk about comp structure, it's typically going to be the same. We want to stick to flat rate only because it gets really bonkers. Okay. So a lot of these like websites and software, et cetera, they actually have affiliate arrangements. So if you go on social media and you find some guy that goes viral, all of a sudden you look at their profile, you realize, oh, I see. They're actually sponsored by this company. Okay. So you have to understand that they always do flat rate. They might say $100 per person that visits or $200 per person that uses my code to buy a pair of shoes. But when it comes down to it, if you're going to have an affiliate, you always want flat rate. And the reason why is because speed is better than long-term. The reason why they're doing the affiliate arrangement is cash flow. All right. So we need to focus on the cash flow for them up front. And, you know, analogy I'll give you is this. So, you know, workplace lawsuits like workplace injury is really big in motor vehicle accidents. So what ends up happening is this: you're the person that gets injured, right? Whether it's at work or in a car accident. You have an attorney, and the attorney's like, hey, because of their insurance, you're probably going to settle for roughly like $50,000, maybe up to $75,000, but it's going to take 6 months. In the meantime, you have no car. So what are you thinking? How do I get my car replaced? Forget your insurance, but like you're thinking cash flow. Okay. So what ends up happening is they'll say, okay, cool. We're willing to do incentive based where we're not going to take any money up front, but out of the 50 grand or 75 grand, after you prevail, we're going to keep 15% contingency basis. Awesome. Well, enter in the affiliate, the analogy. You are the affiliate. You say, hey, I'm willing to front you the money for that car accident settlement. So you're going to get $50,000 maybe. I'm willing to give you 35 upfront right now, and I own all the rights to the settlement. So then you pay out the attorney their 15%, and you pay out 35, and you're going to profit 20, 30, 40 grand because you're willing to wait. So this is the relationship, is that you value the long-term consistency. They value the short-term cash up front, even though it's going to be less. And that's the way you want to look at affiliates. It's really simple, but sometimes we get a little more caught up than we have to. That's why they are an affiliate, right? So if we're going to go over speed, well, we want to have a speed bonus for them. That's the one variable. So we can say something along the lines of, hey, if you get X, Y, and Z accounts within X, Y, and Z time, that equals this incentive. Or if X, Y, and Z percent of accounts start within X, Y, and Z time, it equals this. So the reason why we want to incentivize speed is because you are working with them because they have some type of distribution. You don't just get everyone as an affiliate relationship. That just makes them a 1099. Well, you're not going to go to a homeless person and say, anybody you see walk by, tell them about crypto payments. No, you're going to talk to the person, you're going to talk to Mohammed that has, a whole freaking group of smoke shop owners. And you're going to say, hey, if you can get 10 of them to sign up this week, I'll give you X, Y, and Z, because you understand that their distribution runs out initially and they have to acquire new people, but you want to squeeze out as much juice as possible from them. Okay. And it's the same thing. Cross sells become the same. The way you structure the deals become the same. Contract, obviously you have a contract in place, but that's basically it, right? So when you're tracking these payments, okay, this is going to be the last part. A few different things, all right? Payments and tracking. So number one, you need to have a contract in place. It's either going to be 1099, W-2 employment, or affiliate. Number two, we need to have some ledger or transaction history. And then we need to have some unique tracking mechanism. These are not the same, just to be clear. So what's that mean? Oops. So a few different things, okay? So let's pop this down to a new page. So number one, contract. So there needs to be some type of way they absolve you. Responsibility, limit liability. It's gonna be number one because they're out there talking to people. They might make claims, etc. Other thing is going to be clarification of financial terms, clarification of the process. Because they might say, well, no, the guy said he's interested. Well, like, yeah, he said he's interested, and that's it. He didn't fill out any paperwork. He didn't get the device. He did nothing. It's like, but that's a closed deal. So we need to clarify this, right? And then we need to have, it needs to be future oriented because we need to paint the picture because they're going to stay with you. You only start working with people for long term. Like you don't want to have them in as like seasonal work unless you're specifically saying that. So it needs to be worded in a way that's saying, hey, I want you to grow with me. So X, Y, and Z is the incentive in the future. Okay. So we typically have this. Then when it comes down to ledger or transaction history, we need to have a way that we say, hey, this is the central area of accounts. Okay, term I made up right now, but this is the master list of where all the accounts are. Okay, so we know what stages they're at and updates and a communication method. So we say once they get to, so i.e. stage 2, which is documents, you are notified. Okay, so this is just an idea. So once we have that, the third thing is a unique tracking mechanism. And you notice we do the same thing for you as a client. What's that mean? Well, there needs to be some type of unique code or some way to differentiate who. Because what ends up happening is this. They talk to a business owner and then all of a sudden you get a lead on your website and the website says, oh yeah, I'm interested. I'm ready to sign up. And they sign up directly with you. So then that affiliate says, hey, I sent them over. Like, what do you mean? They went to my website. Like, well, how do you think they found you? I'm like, I don't know. And it's like, well, look, I texted them. So we want to have some type of unique mechanism. So we say, hey, every time they sign up, you do this or that or this. But that's it, because then you can just ultimately do what? You can determine very quickly who is this. Because ultimately, the main thing is you need to build trust. Okay. I'll give you an example. I've had marketing agencies and I've had leads close like years ago. And I remember I was talking to one marketing agency and they just got so used to being screwed by other clients. And at the end of the month, when the ledger was due, he said, hey, these are all the clients. This is what happened. This is transaction history. And they said, oh, we didn't have these 3 people. It's like, okay. It's like, it's pretty badass. I'm like, what do you mean? It's like you guys are super honest. I'm like, yeah, I was a freaking cop and this and that. It's like, yeah, you don't get it. Like in marketing in the space, like people just lie. And that's the case, guys. You have to understand. People just lie. They're going to try to snake you on these deals. So for us saying, hey, these 3 came from you. We tracked them independently. I know it doesn't show under your link, but they said that they found us from X, Y, and Z podcast or live event or whatever. So the fact that you did that, boom, you bought goodwill. And this goes back into why good people stay with you. Why? Because ultimately it's not just the money. It's like, hey, I'd rather work with somebody I trust versus somebody else, right? So pretty simple. Again, at the end of the day, these are different factors as to how we get people to start working with us, whether through an affiliate arrangement or going to be directly employed with us, contractor or not. But either way, it's to expand your business empire with the means of other people also, right? So with that being said, I want to answer any questions that have come up from this, right? I know I had a message sent beforehand, so I'm going to pull that up. Clarence, I don't have my account set up for residuals. Just we'll tag in your group chat for that to get you set up for your residuals. Any questions on team structure, et cetera, guys? I'm going to give you guys a second to get that in. And if you don't, no worries, because after this replay, because it was roughly an hour, we'll answer it in the chats, and then we can even pull it up on Thursday. So I'll give you guys a second. Okay, cool. Not seeing any. So just a reminder, guys, we do have this calculator we just built out for you. Pretty simple. You can access it online. It's only for clients. Just comment residual. I saw the guys that commented already. We'll shoot it over to you. You'll bookmark it. And there's a few of the cool things that came up with just to make it super efficient. Like the whole idea is that you will never be in your office or your house to do this. You're mobile. You're on the plane. You're driving. Obviously not texting and driving, but using tech to expand much quicker. So if you have any specific requests for technology, let me know, because we can facilitate a lot. So website, software, the tech background, we can, we're making a few different changes to make it easier for you to work. So just let us know. But until then, guys, I will catch you on our next training. It's going to be on Thursday, May 28th at 6 p.m. Eastern time. We'll talk about sales, deals, and all that good stuff in between. So till then, enjoy the rest of the evening, guys. Right?